If you're like most people, you probably have a lot of questions about finance and investment. In this video, I'm going to answer 10 of the most common questions that banks don't want you to know. I'll also give some advice on how to avoid common financial mistakes that people are making. Today I'm here to talk about finance and investment. If you're like me, you've got a lot of questions about these subjects but don't feel like you can ask them because they might make you look stupid. Well, fear not, because today I'm here to clear up any confusion and tell you all the do's and don'ts when it comes to finance and investments. So whether your goal is to save for a down payment or simply invest for the long term, this video is definitely for you. Let's begin. Number 1. Banks are in the business of making money, not helping you save it. Banks are in the business of making money, not helping you save it. They are for-profit institutions, so their primary motive is to generate revenue. That's why they charge fees for services and offer products that may not be in your best interest. If you're looking to save money, it's important to be aware of how banks operate. Here are some ways banks make money off of customers. Charging fees for services. Banks charge fees for everything from ATM usage to account maintenance. These fees can add up, especially if you're using multiple services. Offering products that may not be beneficial. Banks often offer products like credit cards and loans that may not be in your best interest. They do this because they make money from the fees and interest charged on these products. Investing your money in their own interests. Banks invest your money in ways that benefit them, not necessarily you. For example, they may invest in companies that they have a financial stake in, paying low interest rates on savings. Banks typically don't offer high interest rates on savings accounts. This is because they want to keep your money in their own investments where they can earn more off of it. Number 2. Your bank is not your friend. Overcharging for fees and services. Banks frequently charge high fees for things like ATM usage, overdrafts, and even simple account maintenance. They may also charge hidden fees that are not immediately apparent to customers. Offering subpar products and services. Banks often sell products and services that are not in the best interest of their customers. For example, they may sell customer insurance that is not appropriate for their needs, or investment products with high fees. Engaging in predatory lending practices. Banks may offer loans with terms that are unfair to borrowers, such as high interest rates and hidden fees. They may also target vulnerable customers, such as those with poor credit scores. Misusing customer information. Banks often collect a lot of personal information about their customers. They may then sell this information to third parties without the customer's consent or use it for marketing purposes. Number 3. Bank fees are out of control and they're getting worse. It's no secret that bank fees are out of control. In fact, they've been rising steadily for years and there's no end in sight. The average American household now pays more than $1,000 a year in bank fees, according to a new study from bankrate.com. And that's just for the basics like checking and savings accounts, ATM fees and overdraft charges. It doesn't even include things like credit card interest or annual fees, which can add hundreds or even thousands of dollars to your total. But it's not just the amount of fees that's problematic. It's also the way they are structured. Many banks have adopted so-called tiered pricing structures, where the more you use their services, the more you're charged. For example, some banks charge a monthly fee for your checking account, but waive it if you maintain a certain balance. Others charge per transaction fees for things like ATM withdrawals or debit card purchases. And then there are hidden fees like account maintenance fees or inactivity fees that can sneak up on you if you're not paying attention. Number 4. You don't need a banker to invest your money. Let's face it, banks are expensive. They charge fees for everything from account maintenance to transactions. And let's not forget about interest rates. But do you really need a bank to invest your money? The answer is no. There are plenty of ways to invest without using a bank. In fact, in many cases, it may be better to avoid banks altogether. Here are a few reasons why you don't need a bank to invest your money. Banks are expensive. You can get better interest rates elsewhere. There are plenty of alternative investment options. Number 5. Banks deliberately make it hard to get your money out. Banks deliberately make it hard to get your money out. It's called a service charge. They hit you with all kinds of fees, and they know that most people don't bother to read the fine print, so they figure they can just keep charging you and you won't even notice. But here's the thing, you can fight back against these fees. First, know what they are. Second, find a bank that doesn't charge them, and third, use technology to your advantage. There are three main types of service charges that banks hit you with: monthly maintenance fees, ATM fees, and overdraft fees. Number 6. Bankers love to give investment advice even if they know nothing about it. Bankers are often quick to offer their thoughts on where to invest your money, even if they don't have a clue what they're talking about. That's because, as a new report from Better Markets reveals, banks make a lot of money from giving investment advice even if that advice is bad. In fact, the report finds the banks are more likely to recommend investments that are bad for their customers but good for the bank's bottom line. And it's not just a few bad apples. The report found that this is a systematic problem across the banking industry. Number 7. The stock market is rigged, but there's still money to be made there. It's no secret that the stock market is rigged. Big banks and financial institutions have been caught red-handed manipulating the markets for their own benefit. But that doesn't mean there's no money to be made in the stock market. In fact, there are still plenty of opportunities for individual investors to make a profit. The key is to know how the game is played and to be smart about your investment decisions. With a little bit of research and due diligence, you can still make money in the stock market even if it's rigged. Number 8. Bonds aren't as safe as you think they are. Bonds have long been seen as a safe investment, but that may not be the case anymore. Interest rates are rising and bond prices are falling, which means that investors could lose money if they're not careful. There are different types of bonds, but most of them work by you lending money to an organisation for a set period of time. In exchange, the organisation agrees to pay you interest on that loan and then return your original investment when the bond matures. The problem is that interest rates have been rising recently, which means that new bonds are being issued at higher rates. Number 9. You can make more money with a mutual fund than you can in the stock market. A mutual fund is a pool of money that is managed by professionals and invested in a variety of securities, including stocks, bonds, and other assets. The primary advantage of investing in a mutual fund is that it offers investors access to a diversified portfolio of securities, which can help to minimize risk and maximize returns. Mutual funds are a popular investment choice for many investors, and for good reason. They offer many benefits, including professional management, diversification, and the potential for attractive returns. Investing in mutual fund is also a great way to build a diversified portfolio. By investing in a variety of different securities, you can reduce your overall risk. Number 10. Investing. There are many different ways to invest your money. Some people invest in stocks, bonds, and other securities, while others invest in real estate or collectibles. No matter what you decide to invest in, it's important to do your research and understand the risk involved. Investing can be a great way to grow your wealth over time, however it's important to remember that there are risks involved. Before you invest your hard-earned money, make sure you understand the potential risks and rewards. When it comes to investing, there are many different strategies that you can use. Some people choose to invest in stocks, while others focus on bonds or real estate. No matter what you decide to invest in, it's important to do your research and understand the risks involved. If you're thinking about investing in stocks, there are a few things you should know. First, stocks can be volatile, which means that their prices can go up and down quickly. This can be risky, but it also offers the potential for big rewards. Another thing to keep in mind is that stocks are not necessarily a guaranteed investment. If the company you invest in goes bankrupt, you could lose all of your money. Bonds are another popular option for investors. Unlike stocks, bonds are typically less volatile, which means that their prices don't fluctuate. Thanks for your immense support, and if you like this video, click thumbs up and subscribe to our channel for more interesting videos. Thanks for watching this video.